Corporate finance practice problem using OneNote. Calculate multiple bond value. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab, then down in the 1616 Calculate Multiple Bond Value tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations here will be mirrored in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, the calculations on down below. We've got the number of bonds are going to be 92, the face amount 1,000, interest rate 15%, market rate 11%, years to maturity 20, and semi-annual. The bonds are semi-annual. We're going to be calculating the price. The new thing here being that we have multiple bonds. So we've got the new thing with the multiple bonds that's slightly different than the standard calculation of the price we've seen in the past. Note that if you want to calculate and work on just bond price calculations, normal bond price calculations, take a look at the prior section where we spend a lot of detail on that. Also note that if you want to focus in more detail on the present value and future value, time value of money calculations, take a look at a prior section where we do that in multiple different ways, comparing the tables versus mathematical formulas and Excel. Here, we're going to do the calculation fairly quickly and just add on the new item, that being just the number of bonds at the 92 to get to the value. So we'll calculate the bond price down below. We'll first just do the normal bond price, and then we'll tack on the fact that we have 92 of them for the complete value. So when we think about the bond price, we have the two things that we're going to put into place. One is going to be the annuity, the present value of the annuity, the present value of, in essence, the interest payments, and then the present value of one, the present value of the amount that would be at the end of the bond. That would be the face amount, in this case, of the 1,000 for one of the bonds in question. And so we'll do a calculation down below. The present value of the interest, we're going to show it in Excel here just to see what the formula would be there. If you want to do it mathematically, or if practice your present value tables or practice your present value calculations in another format, look at prior sections where we focus in on that. In Excel, it would look something like this: negative present value. We're going to be picking up the rate. Now, it is a semi-annual, so this is a little bit tricky in that it's going to be semi-annual. This is a very kind of a complex looking formula, but it's really just because of the semi-annualness, which complicates it a little bit further. The rate would be the market rate. That's going to be the 11%. But remember that the market rate, or the rates that are given, are yearly rate. So usually, unless it's said otherwise. So if we need some other period than the year, then we're going to have to make sure we account for that. In this case, we want 6-month period or half-year type of periods. The reason the convention is a year is because then you have nice percentages that are landing usually between 1 and 100. Whereas if you talk about monthly rates, you can get small rates that are less easy to talk about, but you want to have them in terms of the calculation. So we're taking the rate, which would be the 11% market rate, divided by 2. The number of periods would be 20, but once again, there's 6-month periods, so we're looking 6-month periods, and 20 is in years. So we'll take the 20 times 2, or 40, to get to the number of periods, which would be 40, comma, and then the payment. The payment is going to be the $1,000 times the rate, the coupon rate, which would be 15%. But once again, that 15% is a yearly rate, so you would take that and divide it by 2. Divided by 2 here. And that present value would give us the $1,203.46. Then we want the present value of the principal. That's the $1,000 at the end of the bond period. That would be negative present value, picking up the rate again, that being the market rate, the 11%. That's a yearly rate, so we're going to divide it by 2, divided by 2, and then comma, number of periods would be 20, but that's in years. We want 6-month time period, so we're taking the 20 times 2. That's the 20 times 2, and then comma, comma, because this one is not an annuity, but the present value of 1. The future value we would bring back is that 1,000. That formula gives us the present value of the $117.46. So if we add the present value of the annuity, present value of the principal, The 1,320.92 is going to be the price of the one bond, and now we say that the number of bonds is going to be the 92, so we're just going to multiply that times the 92, so the total value then is the 1,320.92 times the 92, or the 121,524.87. So again, the new component is just to take into consideration the fact that we have the multiple bonds that are in consideration. Our strategy here is to just basically calculate them as the price for one, and then we'll multiply it out times the 92 to get to the total value.